Chapter 2, we deal with the accounting for business transactions. So we're going to get more involved in our debits and our credits and building our financial statements. So the basis of a financial statement is all of the business transactions and events that happened in that period. So as we talked about in our first chapter, we have to identify what transactions and events that we are going to record. And we do that based on source documents such as invoices, either that or purchase orders or receiving documentation. There's normally some sort of document that we're going to record. We analyze the transaction again, thinking of our assets equal liabilities plus owner's equity, and always making sure we balance. We record them into our journal entry. Again, we'll as we get into it, it's going to be debits are going to be equal to credits, but we always balance. And then we post those journal entries into their specific ledger accounts to create a trial balance. And that trial balance will be used to create our financial statements. So that's kind of the big overview of the accounting cycle. So what type of source documents do accountants look at? They get bills from their suppliers. They have sales receipts when they sell something out. Checks come in, checks go out. They issue purchase orders to buy some product or larger material items. They pay payroll and have pay stubs and paychecks. And then there'll be bank statements that they need to reconcile to. So there's always documentation that we are going to trace things to and record things from. So what we have in accounting at a business, you're going to have separate accounts. So the accounts are going to identify what it is. Is it a piece of equipment? Is it cash? Is it prepaid rent? Is it supplies? Is it rent expense? You know what I mean? Every single item that we could possibly have a transaction for has a separate general ledger account. Those accounts then will all reside in the general ledger. So a lot of times you'll get like a chart of accounts if you start into an accounting job, and it's going to show you all of the accounts that are available to post to, and those all reside in the general ledger. And again, everything is organized as our accounting equation that we had in the last chapter. So we'll have various asset accounts. Those will equal our liability accounts and our equity accounts. So asset accounts are things like cash. Accounts receivable is when a customer owes us and we have sent them a bill. So we've billed them on account. It's called accounts receivable. Notes receivable is very similar to an accounts receivable, but it's a little bit longer that we're giving them to pay, and we get to charge them interest. Prepaid accounts like prepaid rent, prepaid insurance, some of those kind of costs we pay for a whole year up front or maybe a quarter up front. Anytime we're paying up front for something that we haven't used up yet, we'll put it into a prepaid account. Supplies are that same thought. We're going to buy supplies and put them in the supply warehouse or the supply closet. We haven't used them up yet, so they still have future service potential to us, so that is also an asset. We can have equipment, buildings, land, more of our long-term assets, things that last for years for us, and those are all considered assets. Liabilities are things that we owe. So accounts payable is the most common. When we get a bill and we enter it into our system, it goes into accounts payable until we pay it. Notes payable would be, again, similar to the notes receivable. We have a longer time to pay, and we're going to be charged interest because we're taking advantage of that longer time to pay. We'll do accrued liabilities. We'll get more into those into the next chapter. And then we can have unearned revenue where we get paid in advance. So say like you're an airline company, everyone's buying their airline tickets in advance and paying that business. That business has a liability called unearned revenue until that flight takes off. Our equity accounts are our common stock, which that's the easiest one to kind of get your mind around. When the company sells shares of common stock out to the stockholders, they receive cash and they issue common stock, which is an equity. At the end of the year, if they have net income and they choose to, they can pay out dividends. So that's going to reduce the equity because it's going to reduce the income that was kept in the company, and they're paying it out to the stockholders in the form of a dividend. And then our revenues less our expenses, that comes into our retained earnings based on our net income. but our net income is revenues less expenses. So again, this is that expanded equity section. That's the hardest part of the accounting equation, is kind of understanding that. But it's our common stock less our dividends plus our revenues minus our expenses. And again, remember, revenues minus expenses is net income. So here's an example of a chart of accounts. There's normally numbers associated with them, and like the 1 is going to indicate it's an asset, 2 is indicating it's a liability, 3 is indicating it's equity, 4 is indicating it's revenue, and 5 and 6 would be indicating expenses. So a lot of times that's a common way for companies to do that, but you can kind of see, again, it still maps right out according to our accounting equation. So then this is what you want to start to understand, is the debits and the credits, because that's what accounting is all about. It's all about doing journal entries to record these financial transactions. And those journal entries require a debit and an offsetting credit. Your debits always equal your credits. If we were looking at a T account or the general ledger account of any account, on the left side of that T account is a debit and the right side is the credit. So the left side is the debit, right side is the credit. And when you do your homework and your tests, we always start with our debits. Debits are listed first, and then credits are listed after that. And then this is an important one to understand. I mean, again, possibly print this out, because this shows you what happens to the different accounts. So if we're setting up an asset, we're going to debit that asset. Its normal balance is a debit. If we are reducing that asset, so say we're paying out cash, or we've gotten paid on an accounts receivable, we're going to credit it, because that's going to decrease it. So a liability, when we incur a liability, we're going to credit that liability. That's its normal balance. As we pay the liability off, we debit it, and that will decrease the amount that we owe, or the liability. Equity, its normal balance is a credit, and it's going to be increased by a credit, and then it's going to be decreased by a debit. So again, thinking one step further, our revenues increase equity, so they are a credit balance. Our expenses decrease equity, so those are a debit balance. So again, that shows it a little bit further. So again, it's showing what I just said right there. Now, if we were to open up, like cash is a good account, a T account to look at, and it's called a T account again because we set it up like with that T, with the title name on the top. All of our debits are on the left, all of our credits are on the right, and then we subtotal those, and whatever side has the most is where we put our balance. So that's what that red balance is it saying, okay, it's the sum of my debits minus all of my credits. That's how much cash I have left. So again, thinking of cash is an asset. As cash comes in, we're going to debit it. As cash goes out, we're going to credit it. Its normal balance should be a debit, meaning we have some cash left over. So like as we set our steps, we identify our documents, we analyze the transactions, put them into a journal entry, and then post them into our ledger. That's the first start of the accounting cycle. So here's a properly set up journal entry. It will have a date. It will have our debit account, our credit account. And then again, notice over here, our debits are to the left, our credits are to the right. We start with our debit, and then we finish with our credit. And then we put in a little description, transaction explanation below that. But that would be the proper way to set up a journal entry. Then as that posts into our ledger, so here, this is our cash account. So it's kind of like a big T account if you really look at it, like, I guess the T would go right in there. But we're putting in our debits, we're subtracting out our credits, and then we're coming up with an ending balance over here. But so we're seeing all the transactions that enter into that account. And then this again shows you going from the journal entry, posting into the two accounts that were involved, and then those will eventually post into a trial balance. So you always want to do your double entry accounting. We analyze and process our transactions. We record that journal entry, debits equal credits, and then we post it into those T accounts. So here it is. We identify a transaction, analyze where it's going to go, do the journal entry. So we debit cash, cash comes in, common stock goes out, and then we post it to the applicable T accounts. So these go through the same transactions that we had in chapter 1, where we were just kind of analyzing the accounting equation at that time. Now we've taken it into more detail where we're doing the journal entry. So now we purchase supplies for cash. So supplies come in, we debit supplies, we pay cash, so cash goes out, so we credit cash. And again, we're posting it into the T account. Now you can see that cash has multiple entries, so that will be the case of an account. If it has multiple entries, we just keep showing them. So then they pay $26,000 for equipment. So equipment comes in, we debit that $26,000, cash goes out because we paid it, so we credit that $26,000, and again we put it into the ledger accounts. We purchase supplies on credit. So supplies come in, and then now we create a liability in accounts payable. So we debit supplies for the amount that comes in, that is increasing those, and then we credit our accounts payable. Our accounts payable is a liability, its regular balance is a credit, and it's increased with the credit. Then we provide services for cash. So cash comes in, so we debit cash. Revenue is earned, and revenue increases our equity, so its regular balance is a credit, so we credit consulting revenues. Then we pay an expense. So we pay $1,000 cash for December rent. So cash goes down and rent expense goes up. So an expense reduces our equity. Our regular equity balance is a credit. So expense is always a debit when we are recording it. So we debit rent expense for $1,000 and we credit cash, and again, post those into the ledger. We paid expense in cash, so we paid $700 to our employees. So again, expenses go up, so that's our debit. Cash goes down, so that's our credit. And then we post them into the T accounts. We provide consulting revenue and rental revenue. So then now in this case, because you can have this, there can be multiple line items in a journal entry. So we're going to bill out this customer, so it goes into accounts receivable for $1,900, and then we credit our revenue because revenue is regularly a credit balance. It increases our equity, and so this is how we record it. And then we credit rental revenue. Again, same thing. Revenue is a credit balance, so to record it, we put it in as a credit, and then we trace those into the ledger accounts. Now we receive cash on our accounts receivable. So cash comes in, we debit cash to increase that. Our accounts receivable goes down. The people pay us. They no longer owe us. So we're going to reduce accounts receivable. So we reduce it by crediting it. Oops. And then you can see it goes into the accounts receivable. Now it shows that the people no longer owed us. They paid their balance in full, and then we got the cash. We made a partial payment of our accounts payable. Cash goes down and accounts payable goes down. So to reduce cash, it's a credit. To reduce accounts payable, it's a debit. The regular balance of a liability is a credit. So to reduce it, we debit it. And then you can see as you look at the T account, this was our initial balance. We made a partial payment, so we reduced it, not completely, but it's going down. Now we pay a $200 cash dividend. So then our dividends are paid out, and dividends are paid out of equity. So when we reduce equity, we debit it. So we debit our dividends, and then we're paying our cash. So we credit cash. Then we receive $3,000 in advance from a customer for consulting services. So cash comes in. We have not performed the revenue yet. We have not earned the revenue. So revenue is, so a liability is created. and that's going to be called unearned consulting revenue. So again, it isn't revenue yet, it's a liability at this point, but we record the liability with a credit balance, and then both of those post in. Then we pay for insurance in advance. So we're paying $2,400 for a 24-month insurance policy. So cash goes out, so we credit cash. Prepaid insurance is a current asset. We're going to set up this current asset because we paid in advance. So to set up this current asset, we debit prepaid insurance, and then to reduce our cash, we credit cash. So again, new asset, cash goes down. Now we purchase supplies for $120. So supplies go up, cash goes down. So we debit supplies to increase that, and then we credit cash to decrease cash. Payment of expense in cash. So cash goes down, we're paying out cash, and utilities expense go up. So when we record an expense, it's a debit, and then when we reduce our cash, it's a credit. And again, those post into the general ledger. And another payment of cash, so we have salaries and wages expense, and we pay cash. So again, we debit the salaries and wages expense to record that, and then we credit cash to reduce it. So then this shows you all of the transactions. So again, you can see if there's multiple transactions, we just keep it going. But so this is all the cash that has come in. These are all of our cash that goes out. Again, debits and credits. And then we have a net debit balance, which we should because cash is an asset. Same with supplies. We don't have anything going out yet, but we have a variety of things coming in. Then here we have some payments that we made where there's a liability set up and payments that are made out of it. So then from those T accounts, we are going to prepare a trial balance. So you look at those T accounts, you list each one of those accounts out, and then you put, do they have a debit balance or do they have a credit balance? And then because again, accounting, everything has to equal. Once we put it all together in that trial balance, our debits need to equal our credits. So then here is what they've done. They've taken all of those T accounts and they list them all out here, and they do go in a certain order. So we start with all of our assets, then our liabilities, then our equity, and then again, in our equity, we've got our revenues less our expenses. But when we put those all in and we carry their balances in, that would have come right from those T accounts, we see that our debits equal our credits, and then we know that we have a good trial balance. Now then, from that trial balance, we are going to prepare our financial statements. So we're going to prepare our income statement, our statement of retained earnings, and then our statement of cash flows. Again, the statement of cash flows, or sorry, did I say balance sheet? Balance sheet. So that's really statement of cash flows we will get to later. So we're going to prepare our income statement, our statement of retained earnings, and then our balance sheet. Those are the three most common ones. Again, statement of cash flows is a little bit more advanced, and we get to it in chapter 12, so it's going to be a little ways away. So our income statement is our revenues less our expenses. So here we've got a title for our revenues. We list them out and then we total them. Title for our expenses, list those out and total them. And then notice how it's set up, because you'll have to do that in the homework. So to the left here, we're running a total. So these two added together equal that. These three added together equal that. And then our revenues less our expenses gives us our net income. And then our net income then rolls down, rolls down into our statement of retained earnings. So our statement of retained earnings, we start with nothing because it's a new company. We add in the net income, which again comes directly from that income statement. And then we subtract out any dividends, and that gives us our ending balance. Now notice on here, we've got for the month ended and for the month ended in our headers. Then when we get to the balance sheet will not say for the period ended, it'll just say the date. So you do kind of have to know those headings. But as we look then go to our balance sheet, again, our balance sheet is the accounting equation, assets equal liabilities and equity. But the retained earnings balance that we calculated in the statement of retained earnings is it rolls down into our balance sheet. That is the only way that your balance sheet will balance, is if you've calculated this out first and you carry that ending balance down into the balance sheet. But then again, you can see the assets are all listed out to get to our total assets. Our liabilities are listed out to get to our total liabilities. And then our equity is listed out to get to the total equity. So you do want to understand those entries and how to, how to build the different statements.